Hi, it's Jim Mitchell again. Got some great ideas here that are going to help you learn how you can work with your tax advisor to save lots and lots of money on taxes. Now remember, if you wish to have some of this information after you've looked at the videos, we can make it available to give you information that will help you or answer questions regarding that, and you can give us you can write us and email us and make sure we'll answer some of your questions. We're going to talk about a tax estimate today. Now, this is on an actual case I've got, and I've got a significant 1-hour presentation on this one, but it's called David and Laura Copperpot. Now, where I came up with the name is got a long story that I'm not going to share with you, but basically it's an actual case, but not the same name, obviously. And basically what we're going to look at is we do what we call a tax estimate for our clients. Now, can you imagine having your taxes estimated and putting them on one page? Well, you could ask your tax advisor to do that. They've got the ability to put all that information and sit down with you and strategize on what your taxes are going to be. 95% of the time, when we have someone who is working with somebody else and we grab their taxes, we save them thousands of dollars in new and old tax savings that we find. Here's an example that we had here. Okay, we had this couple had wages. The wife was working. She is 64. He was 65. Wife was working. She made $10,000. They had interest and dividends of $8,620. Had retirement income of approximately $27,500. They had Social Security of $22,000, and as you know, up to as much as 85% of that can be taxable. They had capital gains on the sale of stocks. Well, that's not a surprise from last year. They had some rental property, and it had a little bit of a gain. They had IRAs, and they were taking $19,500 for a total taxable income in this particular case of $85,000. So, they had taxable income or gross income of $85,000, $85,342, I'm sorry. So 342. Okay. Now, at the time when we met them, they were putting $5,000 into an IRA. The wife was, and she's getting ready to retire this year. They had an adjusted gross income then after the IRA of $80,342. So that line 31 or 32 that you have on your tax form, if you've reviewed it lately, that's what their income was before their standard or itemized deductions came into play. So $80,342. Okay. So now we subtract their itemized and their standard deductions. Now it was they had themselves and they had their grandson living with them. So they basically have a situation where 3 people living in the home, and they had deductions that added up to about $25,550. And they had a taxable income of $59,792. Okay, their tax liability was $7,381, and they had some educational credits that they had from their grandson going to college. Okay, and the educational credits were about $2,600 or $2,500. Now, they had overpaid on their quarterlies of about $6,000. So their accountant that had talked with them before had told them that they needed to pay a larger quarterly. Now, what we did in this particular case, the wife isn't working the following year. She's retiring, so she's not making any income there. That'll help. The interest and dividends, though, what we did there was we took a very close look at that, and we looked at possibly putting that into interest earnings that were tax-free. After they looked at that, they felt very comfortable with that, and guess what? That meant that their interest earnings were now zero. Okay, in the retirement that they were drawing out of $27,500, obviously that won't change. But because we took out less for from their IRA withdrawal, instead of taking out $19,500, we took out $10,000, and that is an IRA Roth rollover. So we're actually going to take that $10,000 and roll it over. Okay. We also took the rental property, and we had them go out and borrow a little money on the rental property, which created a loss and help them not have to pay tax on their rental income. So we moved it from 80,000 on the adjusted gross income to 49,500. Now, these are the kinds of things that can happen if you sit down and spend a few bucks, sit down with your accountant and talk about the things that you want to accomplish, especially reduce taxes, okay? They can help you with some of this stuff. They can send you to a financial advisor. You can go and talk to those people, okay? Now, in addition, okay, the spouse turned 65, so those went up. So we ended up with $26,550 worth of deductions. So it went up a little bit because of the standard deduction went up. We ended up with a $22,950 of taxable income. Versus that, we have $2,617, and basically we took the $2,500 from the tax credit, and they went to $117 in tax. Now, they went from over $6,000 in tax to $117 in tax. That's a substantial tax savings. Okay? Now, that gave those people more money to save for their grandkids, for their retirement, whatever it might be that they want to do, they have money to do that. In addition to that, you have the tax-free income of zero on the interest and dividends, and they went from 2%, which was in the bank, up to 6% in tax-free accounts. Well, it doesn't take a mental genius to figure out that you're going to have a lot more income. So keep in mind, see your tax advisors, talk to them about ways you can reduce tax, and pay a little extra. It will benefit you in the long run. Have a great day. Thank you very much.